Have you ever pondered about the notion of investing in the fascinating world of cryptocurrencies? This emerging digital frontier is known for its intense volatility, yet it also presents a chance for exceptional profitability. The captivating world of cryptocurrencies is packed with opportunities and potential, yet it has its fair share of risks as well. The fluctuating market conditions, the unpredictable price movements, and the ever-changing regulations can make this investment avenue seem like a maze to the untrained eye. However, it's not all doom and gloom. There's a silver lining to all of this. Even amidst the storm, there are investors who have managed to turn the tides in their favor. They've not only survived, but thrived in this tumultuous market. Wondering how they did it? It's not some secret magic formula, but strategies that they diligently follow. The key lies in understanding these strategies and learning how to adapt them to personal investment goals. This is where we come in. We have taken the wisdom of these successful investors and distilled it into 5 key strategies. These strategies are not just theories, but practical tools honed over years of experience. They provide a roadmap for anyone willing to venture into the unpredictable yet rewarding world of cryptocurrencies. Here are the 5 strategies that some investors use to navigate the crypto market. First up, there's holding, or as it's popularly known, HODL. This strategy is based on the principle of perseverance and resilience. It's a committed approach to investment that is about immediate returns and more about the potential for long-term value. In essence, the strategy involves purchasing a specific kind of digital asset, commonly referred to as cryptocurrency, and maintaining ownership of it for a prolonged duration. The investor deliberately chooses to overlook the occasional minor and major swings in the asset's price in the short term. This choice to ignore is not born out of ignorance. Rather, it's a calculated move that is by the belief in the underlying strength of the asset. The investor counts on the prospect of the asset's price rising significantly over time. This strategy is not without its risks. As with all investment strategies, the value of the asset may also decrease over time. However, the defining characteristic of hodling is the investor's willingness to face the inherent risks in anticipation of better rewards. To successfully execute this strategy, it's crucial to identify and invest in fundamentally strong projects. Next, we have day trading. This fascinating strategy, as the name aptly suggests, envelops an intense routine of perpetual buying and selling of cryptocurrencies. Every action taken, every transaction made, is meticulously planned and executed within a single, often exhausting trading day. This method is not for the faint-hearted. The ultimate aim of this strategy is to seize the opportunity presented by short-term price swings. This goal may seem simple, but to achieve it is quite complex. Day trading is a strategy that is firmly grounded on the principles of technical analysis. Traders utilize this strategy by heavily relying charts, diagrams, and a plethora of various trading indicators. These tools aid them in making informed and calculated decisions. It's not just about being reactive to the market scenario, but proactive in anticipating the market trends. However, it's essential to note that this strategy demands a profound comprehension of market trends. It necessitates a dedicated and passionate involvement. In addition, it also requires a significant time commitment from the trader. It's a strategy that might test your understanding of the market and push you to your limits. Be prepared, though. It requires a deep understanding of market trends and a significant time commitment. Following up next is the strategy known as swing trading. This particular technique in the world of trading is often contrasted to day trading. However, what sets it apart is the marginally extended time frame that it operates within. Swing traders, as the practitioners of this method are called, have a characteristic approach to trading. Their target is not the long-drawn, years-long trends that some investors might seek. Instead, set their sights on short to medium-term fluctuations in the price of assets. They engage in a meticulous game of observing, investing, and waiting. Their gambit is to strategically capitalize on these shorter-term price movements. Typically, the duration for which they hold on to their positions in the market is quite variable. It can range anywhere from a couple of days to several weeks, depending on the trader's assessment of the market conditions. Needless to say, to effectively employ this strategy requires a certain level of expertise. Swing traders to have a solid grounding in the principles of technical analysis. They also need to be adept at interpreting various market signals and indicators. But perhaps the most important skill is the ability to identify potential trend reversals. This is because these reversals often present the greatest opportunities for profit in swing trading. Hence, having a keen sense for when a trend might flip is vital for swing traders. Ultimately, to extract the maximum benefits from swing trading, one needs to have a well-rounded understanding of technical analysis and the proficiency to spot the possibility of trend reversals. Let us now steer our attention towards arbitrage. This concept is a fascinating one in the world of cryptocurrency trading. It's a strategy that is based on identifying and then exploiting the price variances of the same cryptocurrency across diverse exchanges. The principle behind this strategy is uncomplicated. Procure the asset from the exchange where it's listed at a smaller price, and then offload it at the exchange where the price is substantially higher. Sounds straightforward, right? Well, on the surface, it indeed is. The key to successfully employing this strategy is understanding the nuances of cryptocurrency pricing and the functioning of different exchanges. Each exchange has its specific factors that influence the price of a cryptocurrency. These may include the trading volume, geographical location, security features, and even the user interface. The arbitrage strategy requires one to be attuned to these aspects. It necessitates keen observation and comprehension of price dynamics. It is not just about buying low and selling high, but about knowing when to buy and when to sell. This can be a highly rewarding strategy if used wisely. However, do bear in mind that this strategy demands quick execution. It is essential to act swiftly, take advantage of the price differentials before they normalize. Furthermore, it also requires vigilant and continuous monitoring of price differentials. A price gap that appears lucrative might close within a few seconds, so staying on top of these changes is crucial. Remember, the crypto market is highly volatile, and while arbitrage presents opportunities, it's equally fraught with risks. To execute this strategy effectively, one must be quick, observant, and dedicated to constantly monitor the price differentials. Finally, we have staking and yield farming. Staking is a cryptographic process that involves locking up a specific amount of digital currency or cryptocurrency in a digital wallet. This is done to support the operations of a blockchain network, which is essentially a distributed database that is used to maintain a continuously growing list of records, called blocks. The main goal of staking is to validate transactions within the network. The stake, or the locked-up currency, serves as collateral, ensuring that the transactions are true and valid. This is an integral part of the blockchain's consensus mechanism, which aims to achieve agreement on a single data value among distributed processes or systems. As a form of compensation for the staker's services, you receive staking rewards. On the other hand, yield farming is an entirely different approach. It involves providing liquidity to decentralized finance platforms. These platforms operate without a central authority and instead run on blockchain technology, facilitating peer-to-peer transactions. By investing your tokens into these liquidity pools, you essentially become a liquidity provider. As a result, you're rewarded for your contribution, earning rewards in the form of additional tokens. Both of these methods, staking and yield farming, offer ways to generate passive income from your assets. However, they are not without risks. Such strategies require a deep understanding of the market and careful risk management. Still, with due diligence and proper research, it can prove to be a lucrative venture. Both strategies provide passive income but come with their own set of risks. To sum it up, the 5 strategies we've discussed are holding, day trading, swing trading, arbitrage, and staking and yield farming. But remember, the cryptocurrency market is dynamic and trends can change rapidly. Diversification, risk management, and staying informed about market developments are essential, regardless of the strategy you choose. Be cautious of potential scams and only use funds you can afford to lose. It's always a good idea to consult with financial professionals for personalized advice based on your specific situation and goals. Happy investing!